and find out that everything is held down.
So that last video is kind of taken off, where I showed there's $200 trillion of derivative exposure in the markets right now, and $121 trillion of that is in swaps, which are super hard to trace. And we talked about how Bill Hwang used swaps to hide his sketchy ass illegal transactions that eventually led to a multi-billion-dollar collapse of Archegos Capital Management, and that had a lot to do with Credit Suisse going under earlier this year. But I obviously oversimplified a lot, and I'm going to show you why. Let's dig into some documents that show how these swaps were working. So we're going to go look up the court documents themselves on Court Listener. You could find this website yourself if you want. This is the specific document we're going to look at, attachment 1. Some more keywords to help you find where I'm at. This is what it looks like. This is the documentation that the court saw about Bill Hwang's short swaps. Literally just an Excel spreadsheet. You'll notice that the swap counterparties are anonymous on this document. That's not by accident. It's possible the court was able to find out who these people were. I don't know, but we can't. And you'll notice that back in 2020, he was doing a bunch of what are called ETF swaps to the tune of $500 million sometimes. Hell, in November 2020, he even crossed the $1 billion limit. And you'll notice that this is a custom basket swap, which means a little package of stocks that they custom make, and they swap all those names together as a basket, quote unquote. And this is where we're going to start to get fishy. If you remember from the last video, Bill Hwang got a little fucked up by the GameStop incident in 2021, which we're approaching here. And you'll notice that suddenly we're not doing ETF swaps, we're doing a shitload of basket swaps, meaning some certain unknown stocks all basketed together in certain proportions, all getting swapped around in secret. Nobody knows. Most of these are in the tens of millions to hundreds of millions of dollars. Then we get to the week where GameStop did its thing, and we're all custom basket swaps for some huge numbers. $500 million right there, almost $500 million right there and there. And this shit is super opaque, but you can kind of track things by looking at swap counterparties and baskets and kind of correlating. So you can see how I've color coded where the same swap counterparty 1, basket 1 gets traded up here on February 10th. And then swap counterparty 1, basket 1 gets traded down here on February 19th, 9 days later, for $244 million there and $229 million here, for $111 million there, $126 million here, $780 million there, holy shit, for $799 million here. Notice these are all short positions, all minus. Not sure if he had any positive positions or if he was only shorting through these swaps. I don't know, but he fucked up. And you can see now why I was simplifying in the last video. Next, we'll elaborate on why we probably shouldn't trust Goldman Sachs with 100-to-1 leverage on their positions.
Let's talk about how much worse this actually has gotten. Bill Hwang, the founder of Archegos Capital Management, gained notoriety for his involvement in one of the largest margin call events ever in history. His firm collapsed in March 2021 due to his highly leveraged short positions, leading to massive losses for banks that had provided credit to Archegos. However, his trading strategies primarily involved long swaps and equity total return swaps, rather than traditional short swaps. He used this derivative to bet on the price increase of certain stocks without actually owning them. With TRS, Archegos could gain exposure to a stock's performance without directly buying the shares, while minimizing disclosure obligations, which might have contributed to his ability to amass large positions. He borrowed heavily from banks like Credit Suisse, Nomura, and others. These banks issued swaps, allowing him to make larger bets than would have been possible with only the capital he had on hand. Ultimately, these high-risk strategies paired with huge leverage and opaque trading practices through swaps led to massive losses and the collapse of Archegos. Now, how much exposure is currently in the derivatives market? You guys saw the clip that I played for you, sitting around 200 trillion in the derivatives market, as well as the coverage of the total swaps. But let's see how much worse it has gotten. The Bank for International Settlements, which regularly tracks over-the-counter derivatives, estimated at the end of 2022 the notional amount of over-the-counter derivatives stood at $632 trillion, and that is at the end of 2022. These banks have not been doing better. As far as types of derivatives go, interest rate derivatives valued at around 417 trillion. Interest rate swaps, options, and futures make up a significant part of that. Foreign exchange derivatives, about 105 trillion. They cover currency swaps, forwards, and options as well. Equity-linked derivatives, 12 trillion, including equity swaps, options again, and futures. Credit derivatives, CDSs, about 8 trillion, but shrunk significantly since 2008, something to note as well, because the Lehman Brothers had a similar situation. And then finally, commodities and other derivatives. Large banks and financial institutions are some of the biggest players in the derivatives markets. Major banks like JP Morgan, Citibank, and Goldman Sachs hold trillions in derivative exposure on their balance sheets. The OCC reports that U.S. banks alone held derivative contracts with a notional value of around $200 trillion as of mid-2023, and we are more than a year later. Like I said before, the actual risk of exposure to losses can be higher due to the inherent leverage in many derivative contracts, which have played a role in several high-profile financial collapses from the 2008 crisis via mortgage-backed securities to the Archegos Capital via total return swaps. Overall, the conclusion is that global derivatives exposure is now over $600 trillion in notional value. You need to let that sink in right now. Basically, these institutions, these funds, these firms can hold stocks without reporting them, synthetically gaining leverage over any given play in the market. Investment banks like Goldman Sachs and Morgan Stanley use equity swaps to provide synthetic exposure to equity markets for clients such as hedge funds who may want exposure without directly holding the stock, just like Citadel, Virtu, and other players shorting GameStop and AMC that don't have to report it. Well, what is the likelihood that they actually are, and how deep could they possibly be? While Citadel's specific number of swaps or total notional exposure isn't publicly disclosed, the firm is one of the largest and most active participants in the global swaps market, particularly interest rate swaps, equity swaps, and total return swap, and CDSs as well. Citadel manages hundreds of billions of dollars in assets with trillions of dollars in notional derivatives exposure across its hedge fund and market making firms. Trillions of dollars in notional derivatives exposure. If they have billions on billions on billions of securities sold, not yet purchased, and yet they are this leveraged in total notional derivatives, as well as likely connected to banks via swaps so that they do not have to report using leverage, how bad could this actually be? Now here's what's so interesting, right? Why do we look at GameStop's chart and AMC's chart and find out that everything is held down and not to go higher? Well, I basically dropped claims from this very, very long Twitter post. Shout out to you for posting this on Twitter. And asked ChatGPT to basically break it down and give me an answer as to how likely this is true. And the conclusion is that most of it is actually likely to be true. There was a shift in market dynamics because small investors ended up taking down big hedge funds during the GameStop squeeze. What's also partially true is that hedge funds use OTC derivatives to manipulate GameStop and AMC's prices. They also use tokenization and artificial supply as well as just blatant market manipulation being partially true according to ChatGPT, and mainly completely true, the financial regulatory challenges that retail has to face trying to play catch up with these large institutions. But here's what's so interesting about this, right? Not only is all of this likely to be true, but even if a hedge fund or institution is shut down, they can still have swap or derivative exposure. They can have contracts with maturity dates that can extend for months or even years. So when an institution shuts down or goes bankrupt, it might still have outstanding derivative contracts. And in a swap or derivative transaction, there are two parties that rely on each other to fulfill obligations. So if one party shuts down or goes bankrupt, the counterparty might be at risk of not receiving payments owed under the swap agreement. It's how you've seen major banks go down like Credit Suisse, like I played the video for you guys. Contracts can be closed out, contracts can be transferred, or the contracts can be allowed to mature. It can obviously have significant risk on the counterparties, like when Lehman Brothers collapsed, leaving behind a massive derivative portfolio to counterparties, which led to a disruption in the markets and large financial losses. But what's happening is they didn't fix the markets, but they're still allowing this leverage to happen at a much larger scale. Meaning if they bring in regulatory ruling and one goes down, they might all go down. Enjoy the rest of your weekend, guys. We'll be back for another one. Spam GameStop and AMC in the comments down below, as well as Ken Griffin lied. As always, get in the Discord. Come talk with me. Come see my trades as soon as I enter them for only a coffee a month. We also have options trading alerts in there, dark pool orders that come through by a bot, insider trades, options sweeps, market news as soon as it happens, so on and so forth. And I only charge a coffee a month because I want you guys to become financially free. Hit that notification bell, subscribe to the channel, get your 15 free stocks by opening a Moomoo account and depositing through my link, and go get my custom indicator. I love you all. Enjoy the rest of your weekend. Lottery stocks out.